While you're listening, okay, I'll start over. Welcome to the Million Dollar Baby webinar. While you are listening to this presentation, if someone comes to mind that you think of that can benefit from this information, please let them know. Invite them to next week, Wednesday, 6:30, or any Wednesday after that. We do have this webinar every week, 6:30 p.m. Pacific Standard Time. It's a valuable information. So hope you have your notepad and your pen. My name is Gabriela Encinas, and I'm an associate with Our Infinite Company. I really enjoy this presentation. I personally have this plan set up for both of my children. I have a 14-year-old daughter, soon to be 15-year-old, and a 13-year-old, and I started them off not right after birth because I wasn't educated. I wasn't informed of this policy. But as soon as I learned the value of the Million Dollar Baby Plan, my husband and I got on it, and my kids now have two of these policies in place. Um, so tonight I'll be presenting with my business partner, Miss Princess Mapp, and I'll go ahead and get us started. And then when she jumps in and I turn the floor over to her, she'll go ahead and introduce herself to you as well. So. We offer this plan, okay? The Million Dollar Baby Plan, also known as the Million Dollar Legacy Plan, because in actuality, it's not only for babies and children, okay? It's also for young adults, the working professional. But we offer this plan specifically tonight for those parents, grandparents. And again, like I said, I'm very passionate about sharing this financial tool with parents because I myself am a parent and because I understand the power of time. Um, did you know that time matters more than money? Miss Princess, did you know that time matters more than money? It sure does, right? So today we're going to share with you the concept that we've nicknamed the Million Dollar Baby Plan. And it's a real simple idea, okay? It's about starting early and using the right financial tools. And so at OIC, our mission is to empower people through financial education and entrepreneurship mentorship. So before we actually dive into the Million Dollar Baby Plan and what it is and how it works, we're going to highlight some statistics of our current financial reality. And as you see them here listed, is that 60 to 70% of Americans live paycheck to paycheck. 60 to 70%. That's even those that are making good income. And a lot of times we're living paycheck to paycheck, not because we are careless with our money, but because life is truly expensive. 47% cannot afford a $1,000 emergency without borrowing money from a family member, from a friend. And I'm talking about emergencies where you have a flat tire or the refrigerator breaks down, those types of emergencies. Another statistic here is that the average American household has a debt of $104,215. That is just wild to me. I don't know about you, but some people might even sit in greater debt, especially if you have a mortgage. The fourth statistic here that you see listed is that the average college graduate owes more than $37,853 in federal student loans. So think about that. I'm done with college. I'm starting off my career, and I already have part of my check being set aside to pay these student loans. What kind of start is that, really, right? If you're just trying to start a life, your own family, a lot of times people delay starting families and home ownership because of these loans. Now, the next one here is that the average monthly Social Security benefit for 2025 is $1,976 per month. That is approximately a little more than $23,000 per year. And with inflation, with the cost of living, I I can't see how we can survive on a fixed income. Now, for those that are not just depending on Social Security, those that are saving in 403b or 401k, when it's time to, as they get closer to retirement, the average person has about $240,000 saved up towards their retirement. That actually, if you're using the 4% rule, withdrawal rule, you're probably only adding another $10,000, $12,000 a year to your income. Lastly, here we have that the average person will change careers every 4 years, even less time amongst those age 35 and younger. And so this is one of the results and why people aren't taking advantage of building that 401k or starting up that 403b, because they're constantly moving. They don't know how to begin, or may ask themselves why even begin, right? And if they did start it, if they did see the value of saving early, but they did start, when they move, they actually end up taking that with them, cashing it out. And they just see it as chunk change, and they don't see the value of allowing that money to grow with time. So tonight we're going to focus on giving our children a financial head start. We're going to discuss how to guide them into adulthood with the right habits and strategies for a strong financial future. And to do that, we're going to go ahead and start with sharing a short video here on what the $1 Million Baby Plan is. Okay?
A pretty money-savvy guy once said, "Someone is sitting in the shade today because someone planted a tree a long time ago." So you're ready to start saving for your kids' future. You already understand the power of compound interest over time, so you know the sooner you start, the better. So where should you be saving that money? Let's talk about perhaps the most powerful and least known savings vehicle for kids on the market, Indexed Universal Life, or IUL. IUL stands out against all other savings vehicles in one main area of strength: flexibility. Other financial vehicles lock you into what you can use your savings on, but an IUL can be a first car, a college education, a down payment on a house, a wedding. IUL cash value can be used however, whenever, and on whatever you choose. Plus, since it's built on a financial chassis of life insurance, your child is instantly covered with hundreds of thousands of dollars of permanent life insurance with living benefits, simply as a side benefit of utilizing IUL as your choice of savings vehicle. Now, don't freak out. The fact that it's life insurance is actually a good thing. Life insurance cash value comes with a ton of unique side benefits, like your cash value being protected from market losses, cash value growing tax deferred and being accessible tax-free, protection from lawsuits, and IUL cash value is not considered in asset calculations when applying for student loans for college. So, what could one of these policies look like for your kiddo? Let's say you had a baby today, and to take maximum advantage of the power of compound interest over time, you immediately start socking away $100 per month into an IUL. Right away, your child is now covered with $371,000 of permanent life insurance coverage with living benefits. That's a pretty nice little side benefit. And that financial foundation you establish for them today will continue to grow with them over the years and be available throughout their lifetime for whatever they need or want to use it for. Plus, if they don't access that money, right around retirement, their IUL is conservatively projected to hit $1 million of cash value. And at age 65, they could turn on a tax-free income stream of $75,000 per year that will last them the rest of their lives, no matter how long they live. The point is, they have options. IUL is the most flexible savings vehicle for children on the market, and the best time to plant that seed is today.
Absolutely, and that's why we're here. So the $1 Million Baby Plan, it uses an indexed universal life insurance policy, which is a financial strategy designed to build generational wealth. It involves purchasing an IUL policy for a child at a young age and funding it over time to accumulate that cash value. The goal is to create lifelong, just like we heard in this video, lifelong financial benefits that include tax advantage growth, a death benefit, and the ability to borrow against that policy for major life expenses. So, what are the top 3 benefits? Again, the cash value growth. A parent, a grandparent, or legal guardian can open the IUL policy for the child. Premiums are paid into this policy, which grows in cash value based on an indexed interest strategy. Okay, one of the examples of an index strategy that we use is the S&P performance with the cap and the floor. But what is index? So in order to understand what index is, we need to explain to you your options for growing your money. Okay. We have three options. You have fixed. Okay. Here you earn a guaranteed interest rate on your money. It's got low risk. Your money won't go down, okay, due to any market losses. The upside, it's steady, it's predictable, a growth. Okay. The downside is it has limited potential on your for returns, the limited potential return. Okay. They're very modest. Typically, you'll see this in like high yield savings accounts, CDs, on average, maybe like a 3%, maybe 3.5% return. The second option for your money would be a variable account. Okay. The variable account, your money is tied directly into the stock market. So the earnings will be based on the performance of the market. There is the risk level here, and that risk is higher than the fixed, okay? Because again, your values will go up and down based on the market performance. So it does have potential for higher growth when the market performs well, but the downside is you can lose when the market, you will lose, not you can, but you will lose when the market drops. Think of a 401k as this type of product, okay? That this strategy or option for your money is tied to. Now, the index. The index universal life insurance uses index strategy, okay? This will offer you a balance between growth potential and protection. So your earnings will mirror, okay, a market index like I referred to earlier, the S&P 500. But you don't actually invest directly into the market. It's just mirroring it. So the risk level here will be a moderate risk. You will have a cap and you will have a floor. You get some market upside, but no downside loss. The cap will limit the amount of interest the policy can earn when the index performs exceptionally well. And then the floor, these accounts include a guaranteed minimum interest rate of 0. So while the rest of the world is losing, you're safe. Okay. Think of it as a safety net that lets you ride the market's waves, but with a life jacket. Hope that makes sense. Now, the other benefit of this type of plan is life insurance, okay, with tax advantage, a tax advantage. Why life insurance? Because when the cash value is tied to a life insurance contract, there are tax advantages. So that's a second benefit is a tax advantage. The cash value, as we heard in the video, grows tax deferred, meaning you don't pay tax on the growth as it occurs. Your child can later access this cash value tax-free through policy loans for education, home purchases, and retirement. And the third benefit, my favorite, is the wealth transfer and legacy. Through an index universal life policy, we're not talking about just protecting a life. We're talking about creating legacy that can last for generations. As your child grows older, they can continue funding the policy and allow it to keep building cash value over time. With consistent growth, this policy can become a potential $1 million asset by the time they reach adulthood or retirement. And here's where it gets powerful. And this is what always gives me goosebumps is that if your child eventually, were to pass away, that policy can grow up to $2 million. When they pass away, it can go directly to the next generation. Even while they're still alive, they can build over $1 million for retirement as well. But think about it. Either way, okay? Think about that impact. If that were to happen to my family, I know that it would completely change the trajectory of our family history and legacy. So those are the benefits. This is a plan that truly builds legacy. And I'm super excited for you to now see some illustrations. I'm going to go ahead and pass it over to my business partner, Miss Princess Mab. she's actually, if you already have a plan in place, she's actually going to show you a quick comparison, okay, between other options, whether you have 529 already in place, the difference between the 529 and the IUL, or if you have a savings that's already tied into stocks or mutual funds. She'll do a comparison. And then my favorite is when she'll show you some illustrations, actual illustrations. So I'm going to go ahead and hand that over to Miss Princess Math now.
Thank you. Thank you, Gabriella. Oh, wow. As a mom, we both are so passionate. So that's why I love this plan. I know we share the same love for it. Hi everyone. My name is Princess and I'm a mom of four and a grandma of three. I'm always reminded about the importance of this type of strategy for my kids. When I first learned this strategy, I thought about all the years no one had taught me these concepts and I couldn't go back and start over for myself. But now that I know, I realize I could change the financial future for my children and my grandchildren. So that's why this presentation means so much to me personally. I didn't have that option when my mother was hit by a car when I was young. I didn't have that option even when she passed. I didn't know any better. So what do they say? When you know better, you do better. So we can't change yesterday, but we can absolutely change what the next generation inherits. So let's look at this comparison chart. And even before I knew about the $1 Million Baby Plan, I looked into other things that were out there, different CDs and the 529 plan, like Gabriella mentioned, but they just didn't seem to check off all the boxes. So if you look here, there is one lane that has all the boxes checked. Here are the eight, biggest features that people typically look for when choosing a long-term savings and investment strategy. We look at the growth potential, right? And that's good. It's checked off across, with every plan that you're looking at. But the growth potential is the ability for money to increase significantly over time through interest and the market gains or compounding. And then we look at, the next one, which is the safety and protection. This is where the protection, from a major loss or market crash or financial uncertainty happens. And they all check that off. But here's where it gets a little bit different. When we look at the tax advantages, opportunities for tax deferred growth or tax-free access or reduced taxable income. That's what people look for when, they want to have tax advantage, right? So this right now, if we look at the comparison in a high yield savings account, we don't get that checked off. And then when you look at the liquidity and the access to the funds, this is your ability to access the funds, access your money when you need it for emergencies, right? Like a lot of people have the habit of going into their 401k, which they shouldn't touch. But when you have an emergency, you can actually access it if you're looking on this chart in the $1 Million Baby IUL. And different opportunities or different life events, right? Marriage, weddings, different things like that. So that's a huge plus. And yeah, in a high yield savings, you might have that access, but when it comes to 529 plan, you don't because it is strictly for education. And then when you look at the guaranteed benefits, this is where these features are provided, for certainty, guaranteed death benefits, income, or pension, principal protection, right? So let's see that across the board. It only is for the $1 Million Baby, the IUL. When we think about the flexibility, can I, withdraw my money, right? That's when you have the option to adjust your contributions, your premiums, your investment allocations, over time. You want to think about different strategies as life changes. So this definitely covers that. Yes, even in a high yield savings, but this is when it starts getting a little bit better. We have the legacy and wealth transfer. What does that mean? This is the ability to leave, as Gabriella mentioned it a few times, to leave money behind for the next generation, for your children and the family members or the future generations. It's a strategy. I'm sure you guys have heard of the Rockefellers, right? That is exactly what they did. They strategized to protect their wealth and, continue the legacy. And then we look at the protection against inflation. That is your growth that can outpace inflation. So purchasing power is maintained over a long period of time. And then another perk is that It doesn't affect financial aid. This IUL, if looking at this chart, you can see it checks all the boxes off. And we'll talk about, now we'll go into the benefits. So what are some of the benefits I just mentioned? All of those benefits, the tax advantage growth. And I hope you guys are taking notes, right? The market protection, the legacy and death benefit. These are the things that maybe you haven't had a chance to think about. But when I was looking at something for my kids, I didn't realize I would have these different advantages, right? They would have these different benefits until I looked at the IUL. All righty. So how do you set up $1 million plan? I know that's what you're asking right now about, right? How do I get my child started? So let's look at this a little bit more deeper and see how do we set this plan up, right? You're going to choose a reputable insurance company. You're going to look for an insurer with strong financial ratings, A plus or higher, and favorable IUL products for the children. Structure the plan properly. That's very important. You know, you're invited on this call by someone who really thought about you. And that's the person you're going to actually probably sit with. And with that time, you're going to, either you're going to be the parent or the guardian. You're going to own that policy and the child is insured, right? And you choose a coverage and funding strategy that maximizes the long-term cash value growth that aligns with your goals through the years, right? The children, there's so many things, that can come up. And again, nowadays, as you can see, there's many opportunities that are happening day to day where kids might not want to go to college fully, but you have the funds available to be an entrepreneur, a young entrepreneur, and start your business. That's the flexibility that the IUL has and that I love, right? And then we also, you're going to dealing with the person. Next slide, please. Dealing with the person, you're going to understand the growth and dealing with the agent that helped you. You're going to understand the growth and the protection features, right? You're going to make sure that they sit down and give you clarity. What does it mean for market index growth potential, right? The S&P 500. Is it maximizing? Are you losing? No. Zero is your hero in this type of a account. There's downside protection with a cap and floor strategies, right? Then it's a tax advantage loan and withdrawal options that are available. And then you have the optional riders for future insurability and long-term care. And you may be asking, right, how do I apply for this, right? How do I fund this policy? Well, there's a minimum underwriting for most children. Actually, they get within 24 to 48 hours. Usually they're approved, right? Depending on the health condition. But 9 times out of 10, it's pretty easy. You begin funding this early so you can maximize the compounding growth. This is where time matters, right? You've heard time makes a difference. And the policy ownership can transfer to the child as an adult. This is where you can take advantage of maybe teaching your child, right, how to save money. You've been paying this policy all these years, and now it's like, okay, I'm going to show you how to become a millionaire, young man. And of course, he's like, how, mom? Okay, well, you're gonna match me, and let me show you. This is where you sit down, you take the time, because nowadays we all need to know about money. This is where you have that opportunity for financial education for your child. You take that moment and say, hey, this is what I've been doing, and what does that look like? All right. And we all may have, and maybe you haven't heard the biblical scripture from Proverbs 22:6. Train a child in the way that he should go. Even when he is old, he will not depart from it. So we're just reminded, this is how we are faithful stewards of what belongs to God. He's entrusted his children with us so that we continue, to keep him in his care properly as we teach our child these strategies, right? All right. So let's look at these real illustrations and see what we are looking at. Okay. So for those of you, please take notes. And this is actually one of our business partners. one of her children's policies. She had a few policies before she started with our company, but she saw the value in the living benefits that we offer here, and she immediately got another one, which is nothing wrong with that. We can have more than one policy, but let's go ahead and just take a deeper look. If you see, she has a strategy because how in the world is she paying $100 a month? And if you look at all these numbers, I believe, what did it say, $6 million? What? How is that even possible? Well, again, that's the compounding interest. Write down the cash value if you can for, oh, okay, I have age 69, right? If you guys write that down, and we're going to circle back around to that shortly. But if you look here, she's contributing $100 a month. If something happens tomorrow, um, they, being the beneficiaries, will receive over $186,000. But then again, if he needed cash through the years, which this is my favorite part, the green, if he needed cash through the years, he's going to be a millionaire before he's 69. What? Who does that? And where can you go and sign up and your kid is like a millionaire at 69? Heck, I don't want to say I'm almost 69, but actually he's going to be almost he's going to have almost $2 million at 69 years old. But then let's take a deeper dive. This is also a favorite part because again, if you heard me mention about my mom, she had hit by a car when I was 18, 19 years old, right after high school. And I did not know any of this. But if it was in place, she would have got a lump sum of over $1 million. And that's what set, this is set. And that's, of course, if she had a mom that started her at a younger age, that money would have compounded. But looking at my business partner and how she set her son up, he's gonna, if something happens to him with a terminal illness, chronic illness, critical illness, critical injury, this money will be advanced to him. And you can only imagine, medical bills is how a lot of people go in debt early. So let's look at the next slide and see. All right. So looking here, as I mentioned, she started with the $100 a month. So let's just take a deeper dive in here. She's paying $1,200 a year. And then she contributes more at the age of 14, right? She starts, putting $200 in. And then she contributes a little bit more. And this time, this is where she's like, hey, son, let me teach you how to save some money. And so she starts doubling it. And, she's still contributing as a mom and she's teaching him a life lesson on how to save, right? But if you look over, it's going, yep. So that money is adding up and she continues to contribute. But then she stops, right? They both have contributed by age 45. He's contributed $147,600. If you look over to the right, that next line, when by the time he's 49, he has $500,000, over $500,000, and still a death benefit over $1 million. But this is when it gets really good because this is where, yes, he has access to these funds. You can, go into business. This is another teaching moment where you can say, hey, let's go get a condo. You're in college. We're going to rent out all other units. And, you're going to go and, he might not be liked by all his friends because now they got to pay him rent. But these are different strategies, right, that you can teach your child along the way. And then think about it. He's going to live to a happy, life and even past 80. We can see the next slide. Does it keep going? Oh, okay, go back, go back, go back. So let's just say 80, but this goes on and on. But this is where it becomes generational wealth. Right here at $3.9 million, that over $4 million can be transferred to the next generation, which I think is pretty darn incredible. Okay, and did you get that? Take this, look at 69, at age 69. Let's go ahead and write down what that number is, right? Now we're going to go, and we'll just say he's Mr. Start Early, right? That's what this kid will be known as. And let's go to the next slide. because little King David is gonna have a lot of money in his account. He gonna rich auntie gonna be visiting him. So, okay, now let's compare, right? Mr. Start Late. This is a 23-year-old young adult, and he's contributing about $150 a month. Something happens, his beneficiaries will have 167,000. Now, of course, he doesn't have all the money add up the same because he's still not at $1.9 million at 74. But if you remember, what was that number? What was that number? 69
It
for,
was 1,956,365.
and he still did not. He's still 20 years late in the game. At 89, he didn't even hit that number. That's why it's so important why we look at these strategies and plans so that we can start our children off young. Let's take a deeper dive into it. Looking at the next slide. Okay. So yes, he put in, let's just say, over the next 10 years, he put in a total of 32,000, right? He's got an accumulated value of 33,000. But what happens if we keep going? He's still contributing and the money is adding up. Nice little death benefit for his loved ones. $500,000 at 57, and he stops. And he's contributed a total of 181,000. And then because he's getting younger and older, well, I say old, but as he gets older, he now has an income switch that was turned on that's going to give him $78,000 a year. Now just think about that. That's on top of his pension, on top of his SSI, which we don't know what that's going to be. But that this is that bucket that's like, at least I know I have this because my mom set me up properly, or my dad. All right, let's continue. And that contribution, this is where it gets really good, right? He has put in 181,000, but at the same time, he pulled out over 1.8 million in his income. Right? And that's at 92. My great grandma passed at 105. So me and God got something going on to 120. So I figure I'll be 92 if I was this young man, right? The money does start, coming out because it is contributing to his income. But this is a strategy. This is a strategy on why it's so important to sit down with the individual that brought you brought you to this presentation. So let's look at the next one because I know you guys are saying, okay, we're still going. All right. So the total amount, uh-oh, the total amount was 181,000, and he had a lifetime income of $4 million. But again, if he didn't even take that income, it would turn into, for the next generation for them to be wealthy, right? So this is not magic, and it's not rocket science. It's a strategy, and that's why it's so important to sit down with a good agent that can really show you how this works. So, why start early? Starting early allows for your payments to be lower and your total contributions to add up, more years for the compounding growth of your money, and a greater long-term cash accumulation, future financial flexibility, and lifelong insurability. Your children don't have to go get another, an exam. This policy transfers over to them as an adult. But all of this is important of why you would want to be Mr. Start early and not Mr. Start late. Okay. Look at those pennies just stacking up over there. So what are the next step? Well, we would love for you guys to get back to the person who invited you, set up your appointment to structure a plan for your own children or grandchildren, and then let us help create your next $1 million baby. And we're here every Wednesday. So please, if you found this valuable, we'd love to hear from you guys. Invite your friends to the next one. Refer any parents, grandparents who you think would love to start a savings for their children or grandchildren. And thank you so much. Thank you, Gabriella, for being my business $1 million partner this evening, and everyone that showed up. God bless you guys, and let's go make some $1 million babies.
Take care. Good night, everyone.
Good night.